Welcome to the Deep Dive. We cut through the noise to get you the insights that matter. Today we're jumping into Nazara Technologies. They're a really significant player, especially out of India, in the whole gaming and youth entertainment scene. Our source, Nazara's own Q1 FY26 earnings call transcript. Lots of detail in there. And our mission, as always, is to pull out the key takeaways looking at their different businesses, their future plans, and the risks they're managing.
Okay, let's unpack this. So first off, let's set the scene. Q1 FY26. How did Nazara actually do? What were the big numbers?
Yeah, it was a remarkably strong quarter. Really shows momentum. They reported consolidated revenues of INR 498.8 crores. That's up nearly 100%, 99% year on year. A huge jump.
Wow, okay. Doubled almost.
Pretty much. And their EBITDA, earnings before interest, taxes, depreciation, amortization, basically operating profit that also saw a really healthy climb. Up 90% year on year, hitting INR 47.4 crores. Profit after tax from their continuing operations was INR 36.4 crores. And the overall PP, profit after tax, hit INR 51.3 crores. That's a 118% increase year on year. Massive surge. Yeah, huge numbers.
And what's really telling, I think, is that their core gaming business, it delivered a really strong 24.4% EBITDA margin, shows the underlying engine is working very well.
Okay, those are impressive figures. But beyond the numbers, what's the strategy driving this? I keep hearing about this IP-led gaming strategy.
Yeah.
What does that actually mean in practice for Nazara?
Right. That's really central to their whole vision. They want to build this globally relevant, respected, durable gaming company, but originating from India. And their approach is pretty disciplined. They're sharpening focus on owning and scaling their own high-quality gaming IPs.
So creating and controlling their own game worlds, basically.
Exactly. Not just publishing others' games, but building franchises. And to back this up, they're developing these centers of excellence.
Yep.
Think of them as internal hubs focused on user acquisition and analytics. So getting really good centrally at finding players efficiently, keeping them engaged, and, monetizing them across all their different games. It's all built on disciplined spending, operational efficiency, and just keeping a steady flow of new games coming out across different genres, different regions.
And it sounds like they're bringing in the right leadership for that. The transcript mentioned Rohit Sharma joining as executive director. Over 25 years of experience, specifically for this IP strategy. How important is someone like him right now?
Oh, absolutely crucial. His background is spot on for this IP-led push. He's basically tasked with accelerating how they create, buy, and grow these valuable game IPs.
Right.
It really signals they're serious about leading in this area. And kind of related, they also showed confidence with some shareholder moves. They approved a share subdivision, splitting one share into two, basically making them cheaper per share, more accessible, and a one-for-one bonus issue. So shareholders get an extra free share for each one they hold. These usually signal management's pretty optimistic about future growth.
Okay, that paints a clear picture of the overall strategy. Now let's really get into the weeds, the different business segments. Which parts are really firing on all cylinders? Let's start with core gaming, which you said saw robust growth.
Yeah, definitely. The gaming segment overall, just exceptional performance, revenue up a massive 160% year on year.
60.
Yeah. And EBITDA grew even faster, up 311%. That's what really drove that strong 24.4% overall margin we mentioned.
Inside that gaming segment, let's look at Curve Games. That was a fairly recent acquisition, wasn't it? What's their deal?
Right. Curve is pivotal. They bought 100% of it earlier this year. All cash deal, INR 247 crores. It's a London-based independent video game publisher, been around since 2005. And crucially, they focus on platforms like PlayStation, Xbox, Steam, Nintendo Switch, PC.
So that gets Nazara beyond just mobile.
Exactly. It's a major diversification move into the console and PC space, which is huge.
So how's Curve doing now as part of Nazara? Q1 performance?
A pretty good start. In Q1, Curve brought in revenues of INR 54.6 crores and an EBITDA of INR 20.7 crores. So contributing positively right away. They've got momentum from recent stuff like Wobbly Life on the Switch, new levels for Human Fall Flat. Those are doing well.
And looking ahead?
Well, they've managed costs well this year, which apparently frees up cash for new IP opportunities. That includes, interestingly, 2 invite-only titles for the upcoming Nintendo Switch 2.
Oh, wow.
Yeah, and Rohit Sharma specifically called out the strength of their existing IPs like Human Fall Flat, Dungeons of Hinterberg for the King, plus new ones getting the green light. So the pipeline looks strong for growth.
Okay, strong move into new platforms. But let's switch back to their mobile-focused studios. How are they evolving? Fusebox games, for instance.
Fusebox also had a strong Q1. Revenue grew 49% year-on-year to INR 73 crores. EBITDA was INR 10.4 crores, which gives them a 14.3% margin. Pretty healthy.
And what's interesting with Fusebox is how it's changed since Nazara invested, right? It's not just a one-trick pony anymore.
Exactly. That's a great way to put it. It's really transformed from what was basically a single game studio into a multi-game studio, much more diversified. They just launched a new Big Brother game back in May. We've got 2 more big IP-based games coming. And the US launches for Big Brother and Love Island games are positioning them for, more sustained long-term growth. They expect those investments to really start paying off from Q2 onwards.
Right.
And Terry Lee, the CEO there, specifically mentioned using Nazara's Center of Excellence to help them expand beyond just Love Island. So you see that central strategy helping the individual studios.
Makes sense. And seasonality must be a factor, too.
Oh, yeah. Generally, Q3, October-December is best for gaming because of holidays in the West. But for Fusebox, it also ties closely to when the TV shows air. Like Love Island in the U.S. market, that drives revenue spikes in Q1 and Q2 for them.
Interesting. Okay, shifting gears slightly. Kiddopia, what's the story there? Especially around subscribers. I think there was some focus on that.
Yeah, Kiddopia. In Q1, they did INR 45.4 crores in revenue, INR 8.5 crores EBITDA. That's an 18.6% margin. They've been investing heavily in original IP-led content. That's their main game. Like, they launched a Barbie game island in April, Davy John Playroom using the Little Angel IP in May, and a PJ Masks thing with Hasbro in June.
So, big-name IPs.
Right, and that's impacting subscribers. They ended Q1 with 227,000 subs, which is basically stable, just down slightly from 228,000 last quarter. They attribute this stability to being more disciplined about acquiring users, plus bringing in these strong new IPs.
So not chasing growth at any cost.
Seems like it. Management expects these content investments to drive organic growth, and they think they'll get back to overall subscriber growth in maybe another quarter or 2.
Okay. How about Animal Jam?
Yeah.
That one seems to be on a steady upward trend.
Animal Jam had a really solid Q1, revenue up 12.1% to INR 26.4 crores, and EBITDA grew a very strong 55% to INR 5.9 crores year-on-year.
What's driving that?
It's mainly strong momentum in in-app purchases, or IAPs. Players seem really engaged. Plus, they're doing well with community events, social contests. New launches help too, bundles, potions, creatures, that kind of thing. They're also working on a climate-partnered casual mobile prototype that's aiming for a soft launch this fiscal year, FY26. Could be a new growth area.
Interesting. Now, Nazara isn't just digital, right? They have this offline gaming side, too.
Yeah.
Smash and Funky Monkeys. What's happening there?
Correct. Starting with Smash. Nazara picked this up through the NCLT process, that's the insolvency court process, early in FY26. In its consolidation period, just from June 6, it reported INR 8.1 crores revenue and INR 3.3 crores EBITDA.
And the plan for Smash?
It's 2 phases. Phase 1, stabilize and, spruce up the 11 existing centers over the next few months, get them running smoothly. Phase 2 is what they're calling Reimagine Smash 2.0, developing new formats, new experiences, linking it better with the rest of Nazara. Aggressive expansion, adding more centers, is planned for FY27, but only after they nail this Smash 2.0 concept.
Got it. And Funky Monkeys?
Funky Monkeys is already growing nicely. Q1 revenue up 6.5% year-on-year to INR 4.9 crores. EBITDA grew to INR 2.3 crores. They finished Q1 with 12 centers open, just launched a new one in Surat.
And how does Funky Monkeys fit into the bigger picture?
Nazara sees it as really scalable and profitable. Apparently, the centers break even on their initial investment pretty quickly.
Quick payback, okay.
Yeah. So they're confident. Plans are to add another 8 or 9 centers just this year. It gives them that diversified revenue stream of physical presence for youth entertainment, complements the digital side.
Right. Now let's talk about Tukrabazi. That's Moonshine Technologies, right? It's an associate company, so not fully consolidated, but the trends there are fascinating. How was their Q1?
Yeah, Moonshine, they reported their highest ever quarterly net revenue, a huge INR 191.8 crores in Q1. And EBITDA was INR 73.9 crores, but despite that record revenue, they actually reported an EBITDA loss for the quarter.
Hold on. Record revenue, but an EBITDA loss. How does that work? What drove the loss?
Marketing. Massive front-loaded marketing spend. It was a strategic choice. They spent roughly INR 85 crores on a big branding campaign during the IPL cricket tournament.
Wow, okay.
And another INR 25 crores on Shark Tank India. Most of that cost hit in Q1.
So a deliberate investment in brand building.
Exactly, aimed at dominating the market. And despite the loss, the underlying operating metrics were actually very strong. Gross gaming revenue, GGR, was up 46% year on year. Gross transactional value, GTV, up 23%. Deposits up 19%. That IPL campaign drove record numbers of daily and monthly active users, really boosted engagement after an upgrade they did in May.
But given the, let's say, tricky regulatory scene for real money gaming in India, what's the outlook for PokerBazi's profitability, especially with this kind of spending?
Yeah, good question. For this full fiscal year, FY26, they don't expect PokerBazi to be profitable because they plan to keep investing strategically to maintain that market dominance. But FY27 is the target to get back into the black. It depends a bit on market positioning then, but it's crucial to get this. The marketing spend is controllable. The core PokerBazi business itself is actually very profitable.
Wow.
They could turn profitable just by dialing back the marketing spend, but they believe the brand credibility and user growth from these big ad campaigns justifies the upfront cost for long-term leadership.
Got it. Okay, let's move to Nodwin Gaming, the esports side. They're undergoing strategic deconsolidation. What does that mean exactly?
Right. Nazara announced in July they plan to deconsolidate Nodwin, making it an associate company instead of fully consolidating its results. Needs shareholder approval, but that's the plan. This fits directly with Nazara sharpening its focus on core gaming IP. Performance-wise, Nodwin actually had strong revenue growth in Q1, up 49%. But it reported an EBITDA loss of INR 11 crores. The revenue growth came from esports events around big games like PUBG and Valorant.
So why the losses, and why deconsolidate if revenue is growing? What's the long-term plan there?
Well, the deconsolidation is strategic. It lets Nordwind raise its own capital independently and operate with more flexibility, pursue its own pretty aggressive growth plans.
And frees up Nazara's capital.
Exactly. Nazara can then focus its capital on the core gaming businesses, which might be seen as lower risk or more aligned with the IP strategy. Nordwind itself has big ambitions, wants to be a top 2 global youth entertainment company in 3-5 years. Their strategy involves this portfolio approach. Lots of small experiments or micro-incubations costing maybe 50,000 to 8 lakh rupees each.
Okay, trying lots of things.
Yeah, but with a very high failure rate acknowledged up front. Like 70-80% might fail early on, another 30-50% later. It's because they're pushing into new emerging areas. They mentioned some specific failures, wings, freaks, hit by things like the European slowdown, Taiwan risks, US sanctions.
But some successes, too.
Definitely. Comic-Con India is a big one, expanding from 5 cities to 8, now 11, going global. Chess and Playground were also mentioned as successes. The idea is small experiments, then bigger bets on the winners, 10-50 lakhs, then a growth stage, 50 lakhs, 2 crores. They aim for a 2-year payback after 2 years of investment. The goal is to create these long-lasting IPs that eventually have really high margins, like 60-75%. It's risky, especially in emerging markets, but the successes can bring, as they put it, astronomical returns. It's a calculated gamble for category leadership.
Okay, quite a different model there. Now, not everything was rosy. Sportskeeda saw a revenue drop. What happened, and what's the plan?
Right. Sportskeeda's Q1 revenue fell 21% year-on-year to INR 48.1 crores. EBITDA was INR 5.4 crores. The main reason was a drop in organic traffic after that Google search algorithm update on March 4th.
Ah, the dreaded Google updates.
Yep. Their response was pretty swift, though. Cost optimization, renegotiating content costs, right-sizing management. They expect traffic to stabilize in the coming quarters. They mentioned they have experience recovering from a similar hit on another property, PFN, which is now profitable.
Oh, they've been through this before.
Seems so, and other sites in their portfolio are doing well. They think Sportskeeda will recover in 1 or 2 quarters, and they've set up cost controls to manage whether it bounces back quickly or takes a bit longer.
Okay, resilient response. Finally, DataWorks. That showed really impressive growth.
Yeah, DataWorks, which now includes the Space and Time acquisition, had a massive quarter. Revenue up 313% year-on-year, EBITDA up 283%. That delivered INR 106.1 crores in revenue and INR 2.6 crores in EBITDA.
What's behind that surge?
It's really the synergy from combining operations with Space and Time. It's unlocked new client opportunities, lets them offer more services across markets, and gets them into new industries. They're also shifting towards higher margin products and using Space and Time specifically to scale up growth in the UK.
Okay, so stepping back from the individual pieces, what's the big picture? Nazara's overall financial ambition, the industry outlook. What's the guidance?
They reiterated their guidance pretty strongly. They're very much on track, they believe, to achieve or even beat their target of INR 300 core EBITDA for FY27.
So significant profitability ramp up expected over the next couple of years.
Yeah, that's the clear signal. They seem confident their strategy across these diverse areas is nearing a point where it really starts delivering on the bottom line.
And for this current year, FY26, what are the specific engines they expect to drive growth towards that goal?
They specifically called out Animal Jam, Funky Monkeys, Fusebox, and Kiddopia as the key growth drivers for FY26. Those are the ones management is banking on to deliver significant growth this year.
Okay. Now, every company has risks, especially in gaming. A big one is always dependence on the big platforms, Apple, Google. How's Nazara thinking about that? How do they mitigate it?
Yeah, that's a constant factor, isn't it? They definitely acknowledge that dependence. But they have strategies. First, just having a diversified business model helps. They make money from IAPs, ads, sponsorships, not just one thing. That hedges the risk somewhat.
Spreading the bets.
Right. Second, the ecosystem itself is changing. Things like web flows are opening up, allowing more direct connections with customers. Fusebox is already piloting something there. Plus, you see all these challenges globally to platform policies. The expectation is platforms might become more open over the next, say, 2-3 years.
And the acquisitions help too.
Absolutely. The Curve Games acquisition is a major mitigator here. It pushes Nazara strongly onto PC and console Steam, Nintendo. That significantly reduces their reliance purely on the mobile platforms.
Okay, diversification across platforms.
Yeah.
Were any other major risks discussed, and how are they tackling them?
Well, yeah, a few we touched on. For PokerBazi, there's the regulatory uncertainty around real money gaming. That's a known risk. Their strategy is market domination now, leveraging the core profitability, and treating marketing as a controllable lever.
Right.
For Nordwin, the risk is the high failure rate inherent in their experimental IP development model, but they see it as necessary for those potential huge wins in emerging markets. It's part of the strategy.
Calculated risk.
Exactly. And for Sportskeeda, the risk is external factors like those Google algorithm changes. They address that by showing they can react quickly with cost cuts and draw on past experience to recover, demonstrating resilience.
So putting it all together then, we've dived into Nazara Technologies, this really diverse empire spanning mobile games, esports, consoles, offline venues, data. It's quite a spread.
Yeah, and I think the core takeaway really is Nazara's clear strategic focus, owning IP, running things efficiently, being disciplined with capital, all aimed at building this major global gaming platform headquartered in India. Their whole diversified approach across so many segments and platforms, it's not just for growth. It's key to how they navigate this super dynamic industry, balancing that big ambition with managing the inherent risks.
It really is a fascinating case study in strategy within a fast-moving sector, adapting to market shifts, tech changes. So here's a final thought for you to chew on. How well do these kinds of diversified strategies across so many different gaming niches actually insulate a company like Nazara from broader industry slumps? And maybe more interestingly, where do you see the next big wave in global gaming coming from? And could Nazara, with this setup, be positioned to catch it? Something to think about until our next deep dive.